Today, I'm speaking again with the one and only Luke Gromen. Luke, great having you again.
It's great to be here again, Mark. Thanks again for having me on.
Yeah, definitely. Yeah, stranger to our viewers, we talked last time in December of last year, and we were talking about a lot of topics about the dollar, about gold, about Bitcoin. And man, we're living in crazy times. Corona is still around us. The lockdown is here. We have Evergrande in the US. We have a very strong dollar, which is actually weird because actually you're a dollar bear, but the dollar is very strong. So where are we right now? What's your overview?
My overview is that the first global sovereign debt bubble in 100 years that has been bursting was accelerated by COVID, I think is accelerating faster. And so I think we're getting into a number of different crosswinds and dynamics around that. But ultimately, we saw COVID hit. We saw the fiscal response and the monetary response from global fiscal and monetary authorities. And in particular, I'll talk about the Fed, where the US government has been running these significant deficits, a lot of it stimulus driven, and the Fed effectively monetizing it. And we're now seeing we're in this weird crosswind period where the inflation that everyone thought they could never generate has come, which is exactly what they said would happen if they did what is effectively helicopter money, which is, hand out money to consumers, hand out money to citizens, issue bonds to banks, and then have the Fed buy the bonds from the banks. It's basically the Fed handing out money to consumers through a couple of intermediaries. And we've seen, and that's what they needed to do to cushion the real economy blow from COVID. We've seen a couple different rounds of stimulus through this year. Now we're into this weird period where the stimulus is waning. The U.S. is having trouble deciding what it wants to do from a fiscal perspective. That's negative for growth. The Fed is continuing with QE as it has been, but talking about tapering. You've had China's credit impulse slow pretty meaningfully over the last 3 to 5, maybe 6 months. You've seen some concerns around the Evergrande situation and construction dynamics slowing in China, which is beginning to ripple out. You're having energy supply chain issues, I think, tied around peak cheap oil in part. Some of it also tied to, for lack of a better word, bad policy around ESG and renewables and not managing a transition very effectively. And when you layer all of these things on, it's a pretty toxic mix of potential problems but also potential. I mean, you could still at this point take it either way, inflation or deflation, but the longer it goes on, it's really, our view is that it's boxing the Fed into a corner where the supply chains and the inflation suggests that the Fed should be tightening, but the fiscal position means they can't. And I think the big surprise that's coming for a lot of people is when the Fed has to loosen policy further or continue loose policy or loosen it further into an inflation spike. And that's going to, I think, blow some people's minds.
Yeah, definitely historic time. So they're just talking about tapering, but like you said, they can't. Yeah, it will explode everything, and people will just be crazy. So, but let's step up back a little bit, and let's talk about the dollar. Because I think you're pretty surprised that the dollar is so strong, it's rising, and the euro is pretty weak because you, like I mentioned, are a dollar bear. So what's going on? Why is the dollar rising? Did we miss something?
I don't think we missed something. I think ultimately what it speaks to are the short squeeze dynamics that we know exist. And so when you talk about, what we laid out coming into the year was that think about the dollar dynamics as a grid, as an X and Y axis with 4 possible grids. And so it's on the one axis, you have, Fed spends enough, Treasury spends enough, Treasury doesn't spend enough. And then on the X-axis, you have Fed monetizes enough, Fed doesn't monetize enough. And basically, if you have Treasury spending enough and Fed monetizing enough, that's dollar negative. And that's where we were from, call it, March, April of 2020 through, I would say, May of this year. And then any of the other 3 quadrants, whether it's Treasury doesn't spend enough, basically you're not going to be emitting enough dollars into the system, and that's going to start to create slower growth, a dollar short squeeze in terms of basically a global dollar shortage that starts to support the dollar. And so I think that's the quadrant we've been seeing really since May. But then you overlay with that, Treasury doesn't spend enough, Fed doesn't monetize enough. That really can turbocharge a stronger dollar because now you've got not just the Treasury not spending enough, but you also have Treasury crowding out global dollar markets. They're going to be borrowing and stealing supplies from the rest of the world, really turbocharging that stronger dollar. So right now, I would say we're in sort of in between those two quadrants. And so it makes sense what we're watching. But I don't, the $64,000 question is how long can that persist? And that is, I think, where we go from here. I don't think it can persist for very long, but we can certainly talk about some of the dynamics that would make it persist longer and what those impacts would be versus what would make it stop going up from here.
Yeah, on the other side, we see the reverse repo rates, exploding. We had over $1 trillion, I guess it was. So this shows actually that we have a shortage of securities. What's your take on this?
So to me, I think the reverse repo, maybe one of the most under-commented points about the exploding in reverse repo balances has been that on the day that the U.S.'s supplementary leverage ratio, or SLR, exemption for Treasury bonds expired on March 31st of this year, and the reverse repo balance was zero. So we've gone from zero to $1.4 trillion or whatever since April 1st. So I think it's important to go back in time and look at this SLR exemption. So we go back to March of 2020. We have asset prices falling, and then all of a sudden, March 9th to 18th of 2020, as we've talked about a number of times, I'm sure we probably talked about it last time we talked, the Treasury market started crashing alongside the equity market in the United States. So in other words, U.S. Treasury yields began rising with falling asset prices. This was a balance of payments, emerging market type crisis. And part and parcel to that, the Fed came in and started doing 600 plus billion a week in QE. But part and parcel to that was that the U.S. Fed exempted Treasury bonds from this SLR regulation for U.S. banks. And what it basically meant was U.S. banks could buy as many Treasuries as they wanted without any of it counting against their SLR capital ratio regulations. And so it basically amounted to the Fed saying, hey, banks, come help us with QE so that we don't have to do all of this. You can buy some of it. Okay, so that SLR exemption for Treasuries expired on March 31st of this year, which is going to be a problem because now U.S. government's still emitting Treasuries. Banks, in some cases, might have to sell Treasuries to get within regulatory constraints, but they certainly weren't going to probably be buying enough. And so you were looking at a mismatch of supply and demand for Treasuries. What's the Fed to do? And really, there's no reason they couldn't continue it, but it was a political issue domestically here. Senator Elizabeth Warren and others saw it as a handout to banks, which is incredibly ironic because they were really just funding her salary and the rest of Washington, but separate story. April 1st, the SLR exemption rolls off. So how does a Fed get around this? They get around it with the reverse repo program. So basically now, they, instead of as the Fed buys Treasuries, as the Fed buys Treasuries through QE, often from the banks, what happens is they create bank reserves. And so part of what was happening is there's also a regulatory limit on bank reserves. And so once you get rid of this SLR exemption, you have this problem of building bank reserves that needs to be dealt with because otherwise the Fed can't buy the Treasuries from the banks. Banks can't. So what reverse repo does is it effectively sterilizes the reserves numbers. In other words, bank buys Treasury, sells Treasury to Fed. Now bank has reserves, but they start bumping up against reserves levels as well, the reserve limits as well. So what the reverse repo situation does really is it allows the Fed to buy the Treasury put it on the Fed and then repo the Treasury right back to the bank to get the reserves back off the bank's books for regulatory reasons. So to me, it's really the reverse repo situation is on one level reducing. It's a measure of tightening in some way, right? You're pulling reserves out of the system. However, and that's the side that most people talk about, but the side people don't talk about as often is this regulatory side tied to the SLR, et cetera, that reserves that are too high also constrain bank lending. And what reverse repo does is reduces that constraint on the system to allow more room for banks to keep lending. So it's sort of however you want to describe it, but there's both sides to it. To me, it's ultimately a circumvention of these bank regulations that are possibly getting in the way of the U.S. government being funded by the Fed and banking system. So it just gives them another lever to play with. So it's kind of a long-winded discussion. So I'll stop there. But I ultimately think it's tied to, or it's another symptom of the different moves and levers the Fed is trying to make to continue to finance the U.S. government in the face of these big deficits and insufficient foreign demand for treasuries.
Is it also a warning signal that the system is somehow broken?
In short, yes. I mean, I don't think it's a sign that, hey, it's going to collapse or whatever, but it really is. Reverse repo is part of what looks to be an increasing menu of options or of programs the Fed either is putting in place, wants to put in place, or has put in place that basically correct the mistakes the Fed made the last time they tapered, right? So if we go back to 2017 and 2018, when they first did the big QE in 2008 through 2014, the promise was always, don't worry, after the crisis, we're going to reverse our balance sheet all the way back to where it was. And
sure.
The skeptics among us always said, yeah, sure, right. And then they started doing it, and everything was fine. It was going to be like watching paint dry, as Fed Chair Janet Yellen at the time said. And then all of a sudden, it was like lighting the walls on fire. It was not like watching paint dry. It was like lighting the walls on fire. And the issue was basically some of these regulatory constraints meant that as the Fed was pushing this, the debt off of their balance sheet, it was ending up on the system, the banking system's balance sheet, and they were running into capital constraints. And so if you look at reverse repo, if you look at the standing repo facility the Fed has proposed, if you look at the FIMA swap lines the Fed has put in place, all of these things look to be corrections to what they got caught on last time that caused the market to crash in the fourth quarter of 2018, that caused the repo rate spike, that forced the Fed to regrow their balance sheet pre-COVID. All of these things are corrections to that. Now, when I say they're corrections to that, what I'm really saying is they are preparing to QE taper with the left hand while undoing QE taper in smaller amounts with the right hand to basically make sure the Treasury market doesn't break again, which it will if they just start taking liquidity out. And if the Treasury market breaks, everything in the world's going to break. So that's ultimately, to me, the sign. That's why I say, yes, it's a sign the system's broken. They're doing the best they can, but that's what it's a sign of in my view.
Yeah, definitely. And like you said, we see inflation now after more than 10 years of deflationary tendencies. Now we see out of a sudden through MMT, through helicopter money, we see inflation. We have in the Eurozone 4.1% in September. We saw, I think in August in the US, 8.3%. It's crazy. We see velocity of money is just jumping. So what do you think? The Fed said it's just transitory. Don't worry, it will be over on Christmas. What's your take on this?
I don't think it's transitory. Now, it's one of these weird questions where they can make it transitory anytime they want. At the end of the day, if they come out and say, we're going to sell all $8 trillion on our balance sheet by Christmas, we're going to be back to zero on the balance sheet or near zero by Christmas time, the dollar is going to go to, I don't know, what's it, 94 and change day. The dollar is going to go to 200 or 300. The Dow is going to go pretty close to zero. The S&P home price, the system will collapse. And yes, then it will be deflation, or it will be transitory. And we'll have separate issues. However, I don't think it's transitory. And there's a number from a real politics standpoint, from a political economy standpoint, is why I don't think it's transitory. The biggest of these is something we've been talking about, is that if you look at the United States' is, for lack of a better word, income statement, the fiscal position, what we call their true interest expense, which are in treasury spending plus entitlement pay-as-you-goes. It's just the portion of entitlements they have to pay to float the entire entitlement obligation. It's like an interest expense. Anyway, those two line items alone for the US government, just their interest expense, their true interest expense, is still 111% of tax receipts, with tax receipts at all-time highs, and with asset prices, which help tax receipts, pretty much at bubble levels across almost every asset class. And I suspect in Germany, I don't need to explain this, the importance of, hey, your interest expense is more than your tax receipts. Like, I still have to explain as much in here. The implication, I think, is much more understood, just given history, and I think the appreciation of history there of what can happen when you get in a bad fiscal position. And so ultimately, the only way out of this is for the Fed to keep inflating, for the US government to keep inflating, to try to get tax receipts above these fixed obligations. The problem, of course, is that, like German war reparations after World War I, they're moving. So next year, the initial look at Social Security cost of living increases for next year in the United States are 6%. 6%. So that's just on the apples to apples. If you then have to throw in new enrollees and what have you, Social Security will probably grow 10 to 12% next year. So when you say, is it transitory or is it not? Politically, it absolutely cannot be transitory, because again, if the US goes into some sort of austerity, or the Fed doesn't do enough, yes, the dollar will get stronger, but we don't even have the tax receipts to pay our interest, let alone defense, which is $800 billion a year, let alone veterans benefits, which are $200 billion a year after 20 years of war, let alone education department, labor department, national park, everything else the US government does. So they need it politically to be inflation. So that's point one, why I don't think it's transitory. Number two, when you talk to people in the transportation, the global shipping community, I have a couple of good friends of mine there. They're telling me that the very earliest that supply chain disruptions will be normalized is the first quarter of 2023. And there's a whole number of issues around that. I'm told that there are no more container ship hitting the trade. No more supply till 2024 or 2025.
It's very interesting. May I interrupt you? Because that's what actually the central bankers say. They say it's just a short-term problem, because the supply chain issues will be resolved pretty soon, and then we'll be back to normal. And deflation is actually the problem, not inflation.
And it's and you talk to like some of the people I talk to. I mean, they're not guessing. They are.
Yeah, sure.
They're talking to the shippers. They're talking to the shipping lines. They're talking to the importers over here. And they're saying 1Q23 at the earliest. Now, the caveat, of course, is that if you have a demand collapse, that could change, but that's going to create a separate problem. And it refers back to my earlier point about central bankers having some level of control around that. The third thing, and why it's not transitory, is, to me, and this is a big picture thing I think a lot of economists are missing, is for 20 plus years, we've had a disinflationary impulse as we have offshored our production to China. And now here we have us picking a fight with China and talking about reshoring. And the consensus is that, well, that'll be disinflationary too. And it can't be both. It can't be disinflationary on the way over to China and disinflationary on the way out of China. That's not how it works. And so I think you're also seeing this structural issues around just sort of the reordering of supply chains, that if as policy, and you're seeing the Biden policy the same as Trump, right? For a period for the Trump administration, there was a school of thought that said, well, yeah, there is some disruption from the trade war and from the new great power competition. But as soon as we get back to sort of the old Washington people running the show, that will go away. Well, new president, new Congress, they're running Trump's trade playbook. There's articles on it today. They're doing the same things. And so there's something much more systemic that has changed regarding Washington's view of China. I think a lot of that has to do with the response to COVID and how we could not get what we needed, which was something the Defense Department had been warning about for a decade. but most people in Washington ignored it. But COVID brought it home to them. It brought it front and center to their constituencies, and so now they care, and that's fine. So you've got, the political reality that the U.S.'s debt is not payable unless they keep inflating. Yeah. Number two, they can't even make the interest. They can't even make the interest payment. You've got, supply chains that are likely tactically not going to be fixed until 1Q23, barring some sort of demand collapse. And number three, you've got this wholesale shift in global trade patterns, sort of new Cold War, great power competition, whatever you want to call it, that is likely reversing structurally what has been a very disinflationary or deflationary trend for 20 to 25 years. So bottom line, I don't think it's transitory at all. I think transitory is how they're trying to, as I say, ride two horses with one ass. Is basically they are trying to convince the bond market that they're not going to inflate the bond market away. And as long as they repeat transitory, they're hoping people will believe it. It's starting to, I think people are starting to not believe it, but they need to inflate the debt away while convincing the bond market they won't inflate the debt away. And transitory may go down as one of the words that sort of, as a
famous last words.
Yeah, the casualty of war. Yes,
exactly. Yeah. So, but now we see something very odd, and perhaps you can help me out with that. We see a very strong dollar, and of course, commodity prices they falling. But we see now something strange. We see energy prices go up with the dollar hand in hand. This is very odd. What's your take on this? How can you explain that?
I think part of it is this peak cheap oil dynamic. Something I've been spending a lot of time writing about over the last really 10 to 12 months, but really even more in the last 4 to 5 has been this. If you go back, you can see there have been very little growth in oil supplies since 2005 globally, sure, with the exception of U.S. shale. So U.S. shale significantly increased global supplies over the last decade. If you go back in time a little further to 2010, what was really interesting is there was a lot of talk about peak oil, peak cheap oil. There was a German military study that talked about that peak cheap oil would probably arrive at around 2013, and it really wouldn't show up and impact economies till about 2025 or 2026. Interesting. So coming into this year, earlier this year, you saw General Motors come out and say, we're going to roll out 25 new electric vehicle models by, I think, 2025 or 2026, something like that. The one that really caught my attention was Audi. Audi came out and said, we're going to be all electric by 2026. And that one really sort of hit me. I drive an Audi. I love it. It's a great car. Germans are known for their engineering and for I would say, and I say this with all the love of my heart, being of German descent, being very pragmatic about problems, and sometimes to a fault, perhaps, according to some, but very pragmatic just by nature, and very good at engineering. And so here we have Audi, who is very well engineered car, owned by Volkswagen, the single biggest corporation in Germany, single biggest employer in Germany, and going all electric. And it struck me because I learned that going from internal combustion engines to electric is not just, at the last second of production, you just sort of, you don't put an engine in it and you just roll it out and away we go. It's a completely different supply chain globally. It's a massive amount of investment. And so you're talking about making this extraordinary investment, basically wagering a 100-year corporation in the case of GM, or, I don't know how old Audi is, but Volkswagen's obviously, 80, 90, 100 years old. Basically wagering the corporation on the ability to switch from internal combustion engines to electric vehicles in an extraordinarily short period of time for a car company, because car companies, by nature of the model rollouts, the nature of who they are very political, very long lead time companies. They don't do things that fast. And yet here we have GM, and then Audi, and then Mercedes-Benz, and then Nissan, all doing this in this extraordinary period of time when they make so much money on internal combustion engines. In the case of GM, for example, a lot of money in light trucks and sport utility vehicles has been their profit center for a long time, moving away from this. And so to me, the fact that they're moving away from it as fast as they're moving away from it suggested one of two most likely outcomes or explanations. Number one is that this was these major world automakers effectively betting their companies on a virtue signaling exercise around climate change, which maybe, maybe they're all afraid of Elon Musk. Maybe. I mean, and certainly Tesla has done some really interesting things and neat things. With that said, I wouldn't short the German engineering and automaking, especially against anybody. Or option number two is these companies, which are very tied in to their governments just by nature of how big they are, have been told by their governments, there's a fossil fuel supply problem 5 years from now, 6 years from now, or whatever the case is. You need to accelerate a transition to electric vehicle now. And by the way, this ties in with the German Army report from 2010, right? Because they said they said the peak's probably 2013, peak cheap oil is probably 2013, but it's not going to show up till around 2025 or 2026, which is right when Audi says they want to be 100%, just luck of the draw, some coincidence. Audi wants to be all electric by then. So to me, the more plausible explanation is that basically we're getting into a global situation of peak cheap oil, which is not to say we're not going to find more, we're running out. It just means we're replacing $2 per barrel oil from these old supergiant fields with $100 barrel, $120, $140 oil that we're going to need to find, lift, et cetera. And so I think with all that by way of background, what we're watching in fossil fuel markets is, I think, a recognition of this issue in fossil fuel markets where the Americans were the sole source of supply in terms of incremental supplies over the last 10 years, by and large. The Americans high graded a lot of their shale production. In other words, we went and drilled all the best stuff first. They have very steep decline rates. And now we're into B areas and C areas in terms of productivity. And so there's not going to be another 10 or 15 million barrels of oil from shale without a big step up in price of oil. And so I think oil automakers are responding to this. I think we're starting to see this play out in commodity markets. And then I also think on top of all of that, I think Western governments, it seems like especially in Europe, there's a couple special situations. For example, Europe's biggest gas field, Groningen, in the Netherlands, was going to be shut down, I think, by 2027 or 28. As of 2018, it was going to be shut down within 10 years due to, I think, seismic issues was the reason they said. Last year it came out, they said, nope, it's going to be 2022. So now you've got Europe's biggest gas field being phased out. You've got ESG policies in the US, in Europe, around where there's been this. And while I admire the sentiment, I agree with the sentiment. I have solar panels on my house. I put solar panels on my house, but I didn't connect the gas line. I didn't take my wood burning stoves out. I didn't take the natural gas line into my furnace. And so what it seems like to me some of the governments have done in Europe is they put the solar panels up and then they disconnected the fossil fuel lines, and that probably wasn't the best idea in hindsight. And so I think we have that overlaid with this much more structural issue, all of which puts, I think it's almost a perfect storm, potentially a perfect positive storm for fossil fuels. And since energy is the master resource, it's going to filter through into every commodity, I think.
Yeah, look at natural gas, look at coal. It's just at an all-time high, and winter is coming, actually, Game of Thrones, and it will be cold, it will be expensive. So
it's right.
There will be more inflation, so it won't be transitory. And if people freeze, they go out on the street and start a revolution, I guess, because the bill will be horrible, horrible high with these prices we have right now in Europe or in Germany. And it was just a stupid idea to switch off all the nuclear plants we have. So this will be exciting times, I guess. So, but Yeah, but now we see a strong dollar and we see energy prices go up. And then, of course, we see commodity prices go down. And you're a gold bull as well as I am. And we see gold, silver got hammered in the last couple of weeks, of course, because of the strong dollar. So what do you think? Is gas, is coal the new gold, or is the gold bull market over? What's your price action for the future for gold?
I'm still a huge gold bull and silver bull. When I first got into gold and silver was in late 2008. And really a crux to me getting into that was when the US first started to do some QE. We had taken rates down to zero. I had done a lot of reading around peak cheap oil, et cetera. Yeah. And it made no sense to me that in a peak cheap oil world that oil exporters would accept and hold increasing supplies of 0% yielding debt that's being made whole by the Fed by printing money. And so my thought was that if peak cheap oil is in any way a reality, if you're going to have structural inflation in energy costs, that's super bullish for gold, because you're going to need a neutral reserve asset whose face value can float to keep the purchasing power of energy exporters whole, right? And that's in everybody's interest, because if Russia's getting just treasury bonds yielding 0% and the price of energy, the scarcity of energy is rising, the price of energy is rising, effectively what that means is they are losing money on a real basis, right? The real interest rate that they are receiving relative to their energy output is significantly negative, and that makes no sense. So it made, to me, it seemed like you'd expect to see energy exporters like Russia, they would want to reserve gold. And of course, what we've seen in the last 12 years is Russia has reserved a lot of gold. And so I bring all this up as background because if we have this structural energy inflation, as it looks like we're going to me, it's extraordinarily bullish for structurally bullish for gold and for silver, or these monetary metals in particular. Because again, you can't, it's sort of the energy component within gold and silver, the implied energy component. They're tied. And if you look back over time, energy and gold tend to have a close relationship. You know, there's within certain barrels per ounce, but they move together over time. And so I think what we're seeing in energy is quite bullish for gold and silver. I think what we've seen with real rates in the short run, there's been treasury yields have actually risen in this debt ceiling issue, which is very, very different than 2011. 2013, treasury yields fell sharply. So we'll see what that means. But I think gold in the short run has responded to higher yields, higher nominal yields in the US, higher real yields in the US. But I think if you look out beyond the short term, whether you talk about what's happening in energy with peak cheap oil, commodities, inflation, the US fiscal situation, which needs significantly negative real rates just to stay sort of, status quo, not have real issues. It all keeps pointing to the same thing, which is this is a really good environment structurally for gold beyond sort of the near-term trading move.
Okay. So what's your time frame? When do you expect a new all-time high in gold, for example?
I think you start to see it probably in the first half of next year. So there's the BIS, the Bank of International Settlements came out with net stable funding ratio guidance for gold markets last year. Yeah, it was probably more than last year, but the gist of it was they went live at the end of June in the in the US and in Europe, and they're set to go live in London on January 1st, 2022. And of course, London is the center of the unallocated, or the gold market globally, the unallocated gold market in particular. And if you read these net stable funding ratio regulations, they're very interesting in that the language appears to be trying to wind down the unallocated gold market to some extent, which is exactly the opposite you would expect to happen from a policymaking body like the BIS. Historically, these central bankers want to keep gold under control. And a key way they have done that is just by looking the other way and allowing unallocated gold markets to expand more than the money supply has expanded. And as long as unallocated claims expand faster than the money supply, then the price of gold doesn't necessarily need to rise in response. So I think it's very interesting that this policymaking body would be rolling out regulations that would seem to be winding down the unallocated gold markets in London, in the US, and in Europe to lesser extents, at a time when this monetary stimulus seems like it's going to need to continue happening. And so that's why I say, I think ultimately, if the net stable funding ratio, it's been watered down a little bit in London, but even if it's just partially implemented, that begins, I think, to set the stage for gold to be able to maybe stretch its legs a little bit in the first half of next year. As these regulations go into place, I think you're probably going to see less structural headwinds from the expansion of the unallocated gold market in London. It's in policymakers' interest for gold to rise, really for the first time in a long, long time, right? Gold moves higher as real rates move lower. They need real rates to move lower to make sense, to make the debt load sustainable. And so you need gold higher. And so that's when I think we'll start to maybe see gold really make a run back toward all-time highs. Is probably first half of next year.
Yeah, we see central banks buying like never before. Poland just issued today that they will buy another 100 tons of gold. And we see Hungary, we see Thailand, we see India, of course, Japan, China. Every government in the world is buying actually gold as a lender of last resort. It's real money. And yeah, that's interesting. We will see, definitely. And I think the BIS is taking a part of that as well with the new regulations. So let's talk about China a little bit. What do you think? Will we see a slowdown in China? We had Evergrande today. We had 2 other real estate developers who got in trouble, actually not paying back their bonds. So what's your take on China, and will China perhaps create a new deflationary bust?
They could. I think from the banking side of it, if you have a state-owned bank that makes a loan in renminbi to a state-owned property developer effectively, then if the state-owned property developer defaults in local currency to the state-owned bank in a currency that the state can create, right? It's just an accounting. It's like a tree falling in the forest with no one around to hear it.
Doesn't matter.
Happens. Yeah. Now there's some domestic political issues and that they would have to deal with, but I don't think that's a contagion risk. To me, the contagion risk that exists, or the primary one that exists, is around the demand function, right? So if China comes out and says, okay, or as a result of this, these property developers basically stop growing, stop building new things for a year, 2 years, then suddenly I think that's a very real risk of contagion, because that's going to rebound out into the world in terms of demand for construction related goods. It's going to impact what's going on with jobs in China for other areas, right? So maybe property developers won't buy as many luxury goods from Europe because they're not building anything and they're having issues. So I think it's these external demand pull areas, global supply chain issues, where that could be a real issue because of the leverage in the system in its entirety, whether it's corporate, household, sovereign, around the world. The leverage is so high across the system, you really can't have a problem anywhere without causing some sort of problem, some sort of crisis. And so that's the thing I'm really watching for. You've seen a few signs of it, where there's been some Japanese building supply companies that the stocks have been hit a bit. There have been concerns of it. I'm watching order rates. You've seen domestic construction equipment sales in China plummet to 20 or 30% year over year in August. They're down for 3 straight months. Yeah. Those are the types of things you have to watch, because now all of a sudden, having lived through the late 90s, we covered industrial companies at one of my former firms. What'll start happening if this goes on long enough is these, newly used Chinese equipment will start showing up in Italy and in Germany and, or in Japan. And so, Komatsu and Cat and Deere will start selling less, and their orders will fall, and the American industrial and the European industrial indices will fall. And they can't fall because of the fiscal situation and the corporate debt situation. And So that's where you really could see, I think, the real risk of contagion is through sort of the real economy, the sort of an old-fashioned contagion, as I would call it. It go back 20, 25 years. So I'm watching it closely. It could absolutely impact or touch off another deflationary impulse. It could make the central bankers' lives much, even more complicated than they already are. So, let's watch and see how it plays out. But it's a risk.
Yeah, definitely. And if China goes down, then we see definitely commodity prices fall even further. So for the end, I would like to ask you some rapid fire questions. And but you guys, you know why I invited Luke, and I have to recommend your 2 books again, the Mr. X interviews. I will definitely put a link beneath the video. It's worth reading it, and it's just mind blowing. Still worth a read, I have to say. And yeah, but before we start with the rapid fire questions, where can find people more about you? Where can they follow you on Instagram, on Twitter? What's your website? Just give us something.
Absolutely. No, thank you. It's fftt-llc.com. This is where they can find out more about our research product offerings, both institutional and individual research product offerings. And on Twitter, I'm at Luke Gromen, LukeGromen. And I have a pretty active Twitter feed, as you know.
Yeah, I know. I follow him, and you have to follow him as well. I put the tweet and the Twitter handle definitely as well under the video. And little disclaimer, I'm a subscriber of your newsletter. So, but hey, yeah, everybody should. So, yeah, let's ask some fire questions. What do you think? Bitcoin, $100,000 this year. What's your take on this?
Yeah, I think it will.
Yeah. Okay, so we're brothers in minds, you know. Same here, same here. Joe Biden, is he a good president?
Gotcha. Oh, you're going to do this to me, huh?
Yes.
No, I don't think he is, but that's not because I favor one part or the other. I don't think America's had a good president
a long time.
In a long time.
Yeah, but hey, he went down so fast. It's horrible. Yeah.
It's been surprising. I had low expectations, and he did not. He disappointed those.
Exactly. It's funny. Yeah, it's nearly hard to watch actually. But yeah,
it is.
What's your top investment for the 2022?
I would say it's 3 things. I would say it's Bitcoin, I would say it's gold, and I would say it's in electric vehicle metals supply chain.
Okay, that's interesting. Cool. What do you think? The dollar will be over 100 or under 90? But what's coming first?
Under 90.
Oh, okay. He's still a dollar bear. I like that. Will be the US dollar still the reserve currency end of this decade?
Yes, but it will be structured differently.
Digital?
In other words, I hope not. Okay. I fear yes, but I hope not, because I think a central bank digital currency, I think, is a very, very dangerous, slippery slope around personal privacy and the control that gives central planners.
They would love that.
Oh, they would absolutely love it. It's
you make a case for it, actually, Luke.
if I'm them, I would love to, but for me, it's less about the financial repression, and that was bad enough. But what we've seen with certain states around the world, and even parts of the United States, around personal freedom repression as it relates to the mandates that we've been watching, that's where it starts to get scary to me. Because now, financial, okay, they want to, pay me -2%. It stinks. Okay. But now it's, hey, you can't buy food unless you go do this. That's a different animal. And that to me is, it's a dangerous slope to go down. And that's, for me, why I really don't, I hope they don't do central bank digital currencies, but it seems like we're moving in that direction.
Yeah. We're definitely living in historic times, and it's really dangerous, actually, the development we see and what governments do. If you look at Canada or Australia, it's just horrible.
It's crazy. You never would have thought it.
No, no, it's like now I know how Hitler came in power, actually, propaganda and fear. That's it. And I've got friends in Australia. They send me videos and I'm shocked. I'm like, okay, this is Russia, or it isn't, it's Melbourne.
That's exactly right. I mean, there's actually, I don't know if you've seen it out here in America, there's a meme that's gone around and it's somebody holding a sign. It says, if you were wondering if you would have stood aside when Hitler came to power, now you know. And
Yeah.
it's very hard hitting, where it's just, but you see how it can happen because it's just
so fast.
And it's just little by little,
Yeah,
and
exactly.
You look up and you're like, wait a second, how did we get here?
Never go to waste a crisis, Winston Churchill said, and I think the politicians just they embrace the crisis and they say, hey, great, now we can do everything we always wanted, and everybody is scared, and we just do it. Yeah,
that's exactly right.
Yeah, it's horrible. Perhaps I have to move to the US, but no, we'll see.
We'd love to have you.
Yeah, I know. We have to meet, man. Definitely. I still owe you a beer. So another question from one of my followers on Twitter. He asked something similar with Joe Biden again. Will Joe Biden finish his term?
This term, I don't think he will. And I think he may end up being replaced by Harris before then.
It's getting worse and worse. I'm not moving to the US. You can still come to Germany,
But now I don't know that she'll run if she takes over, I don't think she'll be the candidate the following election. I think Democrats will put someone else, because as unpopular as he is, she rates lower in all of our polls.
Yeah. What happened with them? Everybody was actually in high spirits, and now they just went down like a rock. It's what
I thought there was a chance that Trump was our Yeltsin, and now I think that Biden's actually our Yeltsin.
Yeah. Afghanistan was just a mess. Mess. Oh my God. We don't start it because this is just horrible. But anyhow, what was the last stock you bought?
Last stock I bought.
Asked Karen, actually. So it's interesting. You don't even know.
No, I'm trying to think. I mean, I've just been buying gold and Bitcoin. Yeah. I've been buying. Probably the last one was the gold miners. I just bought some more gold miners. I bought them well last year. I wrote them up. I held on to them too long. They've come all the way back. I allocated some more money to gold miners a couple of months ago. I'm not a real heavy trader, but gold miners and I buy Bitcoin almost weekly.
Yeah, same here. So, and then that's my last question, actually. So when would you sell Bitcoin? What price target do you have?
No, I did sell some Bitcoin earlier this year, but that was more a portfolio balancing issue. I was in a good position of it having gotten so big so fast. It was just paid down some debt with it, to be blunt.
Yeah. I talked to Plan B, for example, and his stock to flow model is just working fine, like clockwork, actually. And he said, for example, he expects in December we see the price above 100,000, and then he would take some chips from the table, and then he expects the 4-year cycle, not like Dan Held, who says, "Hey, super cycle, we go straight to the moon and Jupiter or somewhere." So yeah, perhaps it's wise to take some chips off the table when Bitcoin hits 100 or 150,000.
I think for me, I think it's important to understand what it is to think about Bitcoin in the context of your life, right? In other words, so for me, to be blunt, I paid off my house. I just, it went up a bunch and I paid off my house, right? So now you're like, okay, I have no debt. Yeah. That's a really good feeling.
Yeah.
Now, financially, it's a stupid move. I should borrow, I should leave the debt there if you look at it purely from a vacuum. But I'm a business owner. I have kids going to college, which is expensive. So I think it's important to think about things in terms of your life, your own personality, as I think Bitcoin continues to rise. But I think too, as Bitcoin keeps rising and what that's saying about what's happening to the dollar, et cetera, the people that and I'm going to use the extreme example because it's the easiest illustration. The guys that did really well in Weimar Germany when the mark hyperinflated were the people that borrowed money, bought assets, and then paid back the debt leaving just this equity position before it really got too crazy, right? And so they ended up at the end of the hyperinflation with these, at that time, massive industrial assets, et cetera. So to me, it's not exactly a one-to-one, because for a number of reasons. I don't think we're necessarily one-to-one Germany with Weimar Germany. I think Bitcoin is sort of a unique animal in some ways in terms of the way it's sort of rails to a new payment infrastructure, what it's doing to what I think it will do to change the banking system, et cetera, the financial system over time. So it's not a pure thing, but I just think in terms of, okay, what else, I would love at some point to, if Bitcoin goes to a big enough number, take some of it and buy some farmland where, basically I own the farmland free and clear. And now I own a different form of inflation hedged bond with a very low cost of carry. That is, and this I think might be the key, is it's politically acceptable, right? We have seen rumblings in the US, around the world, obviously in China. Regulators don't like Bitcoin.
Yeah.
And I don't think they can do anything. Oh, they hate it. Yeah. But I don't think they can do a lot about it existing, but they can do things like tax it, right? I pay 2.5% a year in real estate taxes in the United States on my house.
Yeah.
If, people say, well, this is just finite real estate, a regulator could say, great, we're going to tax it at 5%. That might still be a great deal. It might, but that the day that it gets announced, Bitcoin's probably going to go down, right? And maybe for a few months after. So it's, I think, just this constant recognition of what it is, what's happening from a macro perspective, what you want sort of in your life, and then sort of diversifying the amount of political risk depending on your area into, a little bit here and there, what I call politically acceptable inflation hedges. So, but I still really like Bitcoin.
Yeah. So, and that's why people have to tip you on Twitter in Bitcoin, Did you already activate it?
I did. I activated it last week, actually, for the first time.
Go to Twitter and tip Luke for this interview. And please thumbs up, share this video, of course, follow Luke on Twitter, and leave a comment, of course. Luke, it was, like always, a pleasure, and I'm looking forward next time we have to meet each other in person. And thank you for your time and for picking your brain. Thank you very much, Luke.
Absolutely. Thanks for having me back on again, Mark. I look forward to that beer at some point here when we finally get back to normal.
And for the next interview, of course, definitely.
Absolutely. Absolutely.
Bye.
All right. Bye, Mark.